Get started. Today is Monday, November 14th. This section is being recorded, 11 a.m. section. First things first, let's put out the attendance sheet. Make sure you assign this before you leave today. So as we go forward, a few things. Today we're going to talk about the Royal Caribbean assignment, and basically then we'll talk about multiples, which will set up your homework 11, which is due next Monday. All right, so, but a few logistical items I want to make sure we cover. First, again, next Monday, two things will be due. This is the Monday before Thanksgiving. First, your homework 11 individual assignment, which will be brought out today. It'll be due next Monday. And also your Dentsu Group Case 3 presentation will be delivered next Monday. 10 minutes per team, similar format to the other team presentations. You can decide who you're going to present on behalf of your team, but even if you're not presenting, all team members must equally participate, and we will have peer reviews again for this presentation. Okay? So that is a mandatory attendance day, okay? Which technically means that if you don't show up for the presentation and we take attendance, you lose 5% of your semester grade. Right? Now, I've gotten several emails from a number of students saying that, oh, we thought we could just be home the whole week of Thanksgiving and it wouldn't matter. Okay? So they're taking off and it won't be showing up. Well, technically, November 21st is not a school holiday. You're technically supposed to be here, right? But I have sympathy and empathy towards those of you that made plans to be home that week. So here's what's going to happen. If you don't show up, I'm not going to penalize you for your grade. However, for those that do show up, and you have to show up to give a presentation, you're going to get 2 points of extra credit. There will likely be 4 total points of extra credit available this semester. 2 of those 4 points will be being here next Monday. Okay, so you don't get hurt by it, but you can be benefited by showing up. Okay, so that's the way next Monday is going to be handled. All right. In addition, on the attendance sheet, which you're filling out now, I have not put in the excused absence to the online attendance sheet. I plan on doing that this week, going back to my emails. If you had an excused absence, I will list you as excused. You need to attend 90% of the classes to opt out of the final exam. Okay? Because of the live classes this semester, that means you can't miss more than 1 live class unexcused. If you miss 2 live classes or more unexcused, you're going to have to take the final exam. If you're not here next Monday, going home to the family is not an excused absence. That will be considered non-excused. So there's 2 consequences to not being here next Monday. Okay? Consequence number 1, you're not eligible for the extra credit. Consequence number 2, it will be an unexcused absence and improve the probability that you'll be taking the final exam. Okay? Group project number 4 is going to be delivered on Wednesday, December 7th. Okay? Which is essentially going to be the last day of class, right? So on that day, we'll do our final group projects on Dentsu and the multiples analysis for their competitors. Now, that Friday, the TAs will put in all of the opt-out criteria for the final exam. And so you'll find out that Friday whether you have to take the final exam, right? If you've opted out, then December 7th is the last day of your class. You'll just get 10 points for the final exam automatically. You're done with the semester. If you don't opt out, then you will have to take the final exam Monday, December 12th, I believe is the day, which basically the last day of class would have been. That'll be the day for the final exam. Okay? And then you take it for up to 10 points because you'll have to actually take the exam. Okay? But we're getting very close to the end of the semester. Just wanted to mention a couple of end of semester logistics. Finally, make sure that you work on your Bloomberg Trading Challenge because you got 2 weeks left in the Trading Challenge. Yes, sir.
Will the final exam be in person, or will it be like the last one online?
It'll be remote during class time.
Okay.
And it's a multiple choice exam.
Gotcha.
So that way it auto scores when you finish, which means I can quickly get your grades in that week. Because if we had to do essays, it would take too long to grade. So it actually helps me help you. All right. But it's going to be on theory. Final exams on theory. Okay? As opposed to the other exam, which were math problems. Any other questions about that? All right, let's just check into your Bloomberg Trading Challenge very quickly. So this is section 101. These are the teams ranked on portfolio value. That last place team is in last place, so the fact that they're about to be disqualified and all their members are going to have to take the final exam probably doesn't matter because they don't care. They're in last place. But I warned you about having more than $300,000 of available cash. $376,896 is clearly a violation. So basically, that team is about to be disqualified from the competition for failure to follow the rules. Okay? Is there anybody on that team that's here today? Is there a reason why you have that much cash?
We sold out of something, and I guess
So when you sell it, you have to buy something else, same time.
can you buy something now?
Why don't you buy something right now? Okay. Now you're still in last place,
Yeah.
but okay. By the way, all teams need at least 10 longs. So the teams at first place has 8 longs. They need at least 2 more longs in the next 2 weeks. Okay, same thing. Team in fourth place needs 4 more longs in the next 2 weeks. Right? But assuming that they get out of cash right now and everybody gets their 10 longs, this would be the ranking as of today. All right. Any questions about the trading challenge? All right, let's talk about homework 10, Royal Caribbean. So when you were working on your Royal Caribbean as is, one of the things that I had mentioned previously for ratios is that when we get to the future, which is where valuation is, we need to make sure we have representative numbers of that future in our valuation. And so when we were building the model, the very first day we started building the valuation model, if you remember in column H, we said equals the previous year, right? And initially we said that would be a placeholder. And then when we did our first valuation for Costco, and then we reused it for Nike, their previous year on their balance sheet looked a lot like what their historical years were and looked a lot like what the future years were likely to be. Okay? That was not the case for Royal Caribbean. This is why you can't plug and chug. Because what the model's going to do, equaling the previous year, is if you look at 2021, which was an awful year for the company, it's going to carry those ratios forward for the balance sheet. Okay? And that's going to cause problems when we value the company. Because when the company's revenue went from about $10 billion a year to $2 billion a year, those balance sheet ratios got really out of whack. And so therefore, those percentages are not representative of the future. So that's the point. We need to make sure that we put in things that are representative of the future when we do valuations. Okay? So here's the problem. 2020 and 2021 were COVID years. And so the ratios, and you can see the big changes in those ratios compared to those historical years. They just don't make sense. So we need to come up with something that looked more normalized. That was what the hint I gave you on Friday was. And that was even when I set up the assignment, I said the past doesn't always equal the future. That was the hint I gave you last Monday. So back to what is more reasonable. What I did for ratios is I looked at 2019 as being the last kind of normalized year. Okay? And I said those numbers probably look more normal to the future than 2020 or 21. Okay? Because when I looked across 16 and 19, those numbers kind of wobbled a little bit, but they were generally fairly consistent. Okay? So that seemed more normal for a normal year at Royal Caribbean. So I could have used some number, like an average of the 4 years or something. What I just chose is to take the 19 numbers and move them over to column H. Okay? For the balance sheet and for depreciation. Because they weren't going to have 84% depreciation as a percentage of sales on a go-forward basis, so we needed a more reasonable depreciation rate. And by the way, when you did that, you got a share price that was very, very close to the actual share price. Okay? So just making sure that everybody understands why we had to do that and what we did. Questions about that? Okay. So when we carried that forward, a couple other things we had to change. One, we had to put in a WACC. Now this is also an important point because on Friday, the government released CPI data. And the CPI came in much lower than expected at 7.7%. But more importantly, core inflation was even lower at 6.6%. And that surprised the market. So what ended up happening, if you remember last week, is that, was it Friday or Thursday? Thursday or Friday, depending on last week. But remember the Dow shot up like 1,200 points that day? Because the yield on the 10-year Treasury fell like 30 basis points that day. Unheard of. So I guess what I'm telling you is your wax could have been different if you did the valuation on Wednesday versus Saturday. Okay. Now I have my data from Saturday, right, which was the end of the week after the market fell in terms of the Treasuries. But nonetheless, you might have slightly different WAC and Gs based on which day of the week you did. Okay? But nonetheless, as of today, their WAC was closer to 7.9%. And essentially, we go back to the ratios. One of the things we had to figure out is their tax rate, representative of the future, and then you see they don't pay taxes. Okay? So Royal Caribbean Carnival historically have never paid income tax. I don't know how they've gotten out of that loophole, but nonetheless, they just don't pay any income tax. That tends to help their values, right? And then when we put in a more reasonable EBITDA, which was what the analysts were forecasting, getting up to around low 30s, which is also forward year 2, forward year 3. I thought forward year 3 EBIT margin looked more reasonable given where their EBITDA margins were in years 3, 4, and 5. So that's the one I used in my perpetuity value. And growth rate's about 6%. Solve for a G, that was around 4%, 3.98%. So that's kind of how I got my as is to equal their share price as of close of business Friday. All right. I assume your numbers were somewhat similar to this, for those of you that did this. Anybody have challenges, problems, etc.? All right. So again, you're going to have to deal with Dentsu. And I alerted you last week, and I'll remind you again, that when I put in the data for Dentsu, the CFI did not balance. And then when I looked at my CFI not balancing, I noticed my TFI didn't balance, so it suggested it was a balance sheet problem. When I started looking through the balance sheet, what I noticed is that the retained earnings that Dentsu was using didn't seem to be the core retained earnings that we're drawing from Bloomberg. I don't know why they're using slightly different numbers than what they have in Bloomberg, but nonetheless, it was causing a problem with my model. So, fortunately, when you look through the model data tab, the retained earnings that they are using on their balance sheet is there. Okay? It's in another field that we're not using currently in our model. And so if you switch that into our standardized balance sheet, that reference, everything will sync. Okay? But you are going to need to do that if you haven't done that already, if you're going to do your density presentation next week. Because an unbalanced model is going to just devastate your grade. Right? So you need to have a balancing model. So there's your hints on what needs to be balanced. So anybody was able to do that? Any questions about that? You have 5 days. All right. So we did the as is for Royal Caribbean. We got a sense that they're growing around 4%. We got a sense that their ROICs going forward were around a little under 10, the 9-ish range, what the market must be using today, and an EBITDA margin of around 30%, 6% growth in the out years. No tax, right? Then we had to do a bull and a bear, okay? So if we did a bull out of this, what were some of the key assumptions that you talked about in your bull? So what would be some of the things that would drive Royal Caribbean to the high end of the range? What'd you say in your write-ups? What'd you refer to? Yeah.
I said if we're looking at the market optimistically and inflation would go down, and people would have more disposable income to spend on luxury goods and cruises.
Okay, so inflation would have been key part of your bull assumptions. Okay. What else would lead to a bull scenario for Royal Caribbean? Did you read anything in their BICO, news reports, etc.? Analyst reports? Did you do any of that? Because when you put a bunch of numbers in there, you can't just put numbers in without the explanation. What would be part of your explanation for your bull?
safety concerns related to COVID, and people are assuming there won't be going forward, so there'll just be more people in general driving up sales.
Okay, so that's gonna give them faster growth and demand going forward. Okay, part of their bull scenario. I can buy that. Anything else that the company talked about that might drive a bull scenario? Like, this is not that hard if you go to your Bicos. And you read through this, like, what are some of the things they're talking about here? Bought a luxury brand. Efficiencies to margin. They talked about improving that. They believe that as they fill up their ships more, that would be better for them. I mean, that's the point. Like, if you go read through these things or the analyst reports, there's assumptions there. If you're not using that, I'm going to tell the TAs to give you really, really poor grades on this assignment. And when you do Dentsu next week, if you just give me a bunch of numbers and you don't give me the real world explanation, you're going to be very unhappy with the grades you're going to get. So when you do your bull and your bear scenario, you got to have rationale for the bull and the bear. And it's got to tie to the real world, what's happening in the company. Can't give me just generic stuff. So when you put in the bull scenario here, where you did talk about the potential lowering inflation, you did talk about their resumed growth and the fact that people are trying to drive that. You do talk about some of their efficiency programs. They're trying to maintain their costs and margins. You did talk about that they're a premium brand strategy that allowed them to get those higher EBITDA margins. That's what leads you to a bull, is probably going to get you a share price in the 70s to 80s. Okay? And then the opposite's going to be true of the bear. Right? Because a lot of the catalysts for the bull are probably going to be things that will hurt you on the bear side. So, for example, if inflation remains persistently high, that's going to be trouble. Matter of fact, just anecdotally, and I'll just give you an example. Like today, we have 5 students who emailed me this morning that either have the flu or COVID. Right? I hope they all get better, but I'm just telling you that we think we're done with COVID, but I don't think COVID's done with us. And so that's another problem. Matter of fact, another headline I read over the weekend was that there was a cruise ship that cruised into, I think it was Sydney, that basically had 800 passengers that got infected with COVID on that cruise, right? And so these things are still petri dishes. And right now, if people basically are ignoring that, and that leads to people going back to cruise, that's one scenario. But if COVID kind of comes back with a vengeance, and a lot of people are getting sick on these ships, and people don't go back as they expected, that could quickly lead to that bear scenario. And all this future revenue that they expect to grow doesn't materialize. Okay, so that would be a key part of what could be happening in the bear scenario. Okay, also, price of fuel. If we have higher fuel costs, those affect the cost of these cruise ships. Right, so that's, again, there are things that come into play. Right? Matter of fact, the other side of it is the premium brand strategy. Royal Caribbean in general is trying to be a premium brand. They bought another premium line. If Royal Caribbean is not able to sell those premium prices, they have to discount a lot on those big ships that they're putting into play, that could also lead to a bear scenario. Because they're putting in a lot of capacity in this industry in an expectation of growth. And if the growth doesn't come, that could be really devastating to Royal Caribbean and to some degree Carnival. So back to what's going to be in the bear scenario that probably gets you to the 30s, 40s, are going to be talking about things like that. Right? But that's the point. You got to give rationale for what's going to drive each of the areas, the bull and the bear. Right? And then you come with a target, which is where your opinion is of where you thought they were going to be. Anybody come up with a sell target for Royal Caribbean? Is anybody on the sell side? Why were you on the sell side?
I thought that persistent inflation and like consumer uneasiness to react to things like cruise ships would persist longer than expected.
Yep. And I can easily see how that played not only in the bear, but why you'd be more at the sell side for that. Same way in the buy side. Do we have any optimists about them? Why were you a buy side?
I was just optimistic about like after the pandemic, like the recovery and more people are gonna wanna travel and like be out. So I think we're gonna do well in terms of that.
Okay.
In the long run.
Yeah. And so that's the point. Like, I can't say that either one of you are going to be right or wrong. We got to go play it out and see what happens. But what's important to me is you put the rationale of your assumptions along with the numbers. Like, that's what's going to be important, not only for your grading, but just doing this process in general, right? Because that's what separates the good analysts from the bad analysts, the ones that can actually articulate the assumptions and has a good rationale behind the assumptions. Because that's what makes the model. It's not just the math. Okay, so we wanted to make sure we're doing both as we're going through this. So back to Dentsu. For Dentsu next week, you're going to be doing this in PowerPoint. So I'll put up some sample PowerPoints sometime later today. But basically, because you can't jump out of PowerPoint, what I saw in the past the teams did is they put their ratios and assumptions into the PowerPoint for each scenario. So when they were walking through the changes, then they could show the numbers and then they just talked about why they changed. Okay? Make sure you also put your other screenshots, your DES, your EEO, and your WAC into that PowerPoint as well, right? But that's the point. Like, you're gonna have to, in 10 minutes, kind of go through these scenarios, which is about 2.5 minutes per scenario, as is bull, bear, or target. So you gotta be kind of efficient on that when you go through Dentsu. But you've also done an EIC. Okay, so it shouldn't be that foreign to you as what's going on with them in the advertising business. You've also done your historical ROIC and CFI analysis, which should give you some additional insight into the company. So again, you can use that information to help you explain some of these scenarios. Questions about Royal Caribbean or Dentsu? Yes.
I think we kind of talked about this when we were doing the EIC, but like finding like industry information for Dentsu,
Mhm.
like do you have like any tips for Bloomberg? I think we kind of talked about it.
I don't remember. Did they have a BICO?
They don't.
Then I would start out at the BI. Just go up to the industry, read the industry report with what's going on the advertisers. There's nothing wrong with using IBIS World. I mean, you have other data sources too. You could use Hoover's, etc., on the web. Because again, you go to any data source. Bloomberg is just more, more helpful. But the other key piece, what I'd be using a lot of, is BRC, because the analysts are talking about the exact same things we are. And so in the sell side analyst report, read 2 or 3 of those. And you're going to start seeing consistent themes start to emerge. What's JP Morgan talking about? What's Deutsche Bank talking about? What's Barclays talking about? And that will also give you some insight into the valuation scenarios. Any other questions? All right, let's talk multiples. So this is lecture note 6. And today we're going to talk about multiples or comparables or comparables, sometimes called comps, which is the last of the 4 sections of the class. So the point is, what multiples do is they use pricing of other things to say, what is our price worth based on similar items? That's basically what a multiple is. Matter of fact, the most common multiple you'll experience in your personal life is if you ever buy a house or refinance a house, because you will be required to have an appraisal of that house. And the appraisal is basically a multiple, right? So what the appraiser is going to do is it's going to say, okay, in the last 6 months, what have the housing prices in your area sold for similar houses? They're going to have the prices of all those houses, all those sales. And they're going to say, how much square foot did every one of those houses that sold have? So they're going to divide. They're going to have a price, and they're going to have a square foot. They get a price per square foot. And they're going to take the average price per square foot in your area, and then they're going to take your house. They're going to say, how many square foot are in your house? They're going to multiply by that price per square foot average, and that's the starting point for the appraisal. Okay? So you can even do a self-appraisal, like you do this yourself. You go to Zillow or some of these other things, get a price per square foot. That's kind of how they're doing it. Times your square feet is the starting point for your appraisal. And I say starting point because then they're going to adjust it up or down based on other factors. So for example, what's your location? How many bedrooms and bathrooms? So if you're a 4-bedroom house with a 1 bathroom, it's not going to appraise as high. People aren't going to pay as much for that as a 4-bedroom house with 3 bathrooms. Okay? So they're going to look at that. They're going to look at the age and condition of the house. They're going to look at the school districts around you. Like, all that's going to adjust that price up or down. And you can even see for some other houses that might have had those characteristics, how much up or down. But that's essentially the concept of a multiple. Okay? So the advantage of multiples is they're easy. The disadvantage of multiples is that they're easy. We're oversimplifying the values. But by looking at what something is worth based on similar assets, we can use this to value private companies. That's something called precedent transactions, like a mergers and acquisition, right? So for example, in Bloomberg, you have a mergers and acquisition database. Just type in MA. Very powerful feature of Bloomberg. Every acquisition, either done or announced, is in here. Okay? So for example, today, okay, there was this morning an acquisition announced by a company called Rheinmetall to buy Explosivos Alaveses, I don't know if I'm pronouncing that correctly, for $1.2 billion in cash. Right? So if you actually click on this deal, then it will give you all the details about the deal. Summary, timeline, party, structure, who the advisors were and what their fees were, any regulatory approvals that either need to be done or were done. But down here at the bottom are the deal comps. These are the trading multiples for the deal. So that's the point. Like if you're an investment bank, you'll look at this. You'll say, okay, what have similar type acquisitions in this industry? What have they done historically and what have people paid for them? Okay. So this column over here is all the prices for all the previous acquisitions. This is the price for this acquisition. And then you basically do multiples. That price divided by EBITDA. Companies in this industry have been purchased usually at 31.2 times EBITDA. 107 times EBIT, 0.61 times revenue. Okay? So the first thing I know is whatever revenue you have, you're probably going to be paid less than sales. 61% of sales on average. This suggests a pretty low margin industry, right? Because usually if you have high margins, I pay a lot for your sales. If you have low margins, I don't pay a lot for your sales. So I can already infer from this that this is basically acquisitions that have been done at a very low margin companies. Okay? It's probably why they have high EV to EBIT multiples, because I'm paying premium for low margin companies. That means price high, margin low, high EV to EBIT, high EV to EBITDA. Because I'm probably expecting some synergies. So what I'm already telling you is, very quickly, I can start making some assumptions from the multiples about the financials, right? Because here's the point. In the valuation section, we did a DCF. We said based on these assumptions and these cash flows, we get a company's price. With multiples, you work backwards. You know the prices. So you're working backwards to understand the cash flows, to understand the assumptions. That's a multiple analysis. And the middle of all of this, you know from your previous finance classes, something called the law of one price, which means even if I change my approach, I can't come up with a different value of the company. If I do a DCF and I look at a multiple, they have to sync up. I can't just use a different approach and come up with a different value. That would make no sense in the real world. So since the company's value is not changing, then the DCF and the multiples have to sync up. So that's the point. If I know the DCF, I can figure out the multiples. If I know the multiples, I can work backwards to the DCF. That's what we're basically about to do in our multiple analysis. So with that in mind, a few more things. One of the biggest challenges with multiples is selecting similar companies, right? Let's say we were doing a multiple analysis on Royal Caribbean. Okay. Who are their peers? Let's go look. So RV. So here's the problem. If I look at U.S. peers, there's not many of these companies in the U.S. There's basically Carnival, Royal Caribbean, and Norwegian. That's it. Now here's the thing. They actually do have another competitor in the U.S. It's called Disney Cruise Lines. Disney's got a pretty big cruising business. You can go to Sea with Mickey, all their characters with your kids. But the problem is Disney does a whole lot of other stuff besides cruise. And cruise is a very small percentage of Disney's overall business, even though it's a pretty big business. So that's the problem. They're not on this list because they're not a direct competitor, but they kind of are a direct competitor. But that's the thing. If I actually put Disney on this list and I'm comparing Disney against Royal Caribbean, Well, yeah, they both have cruising companies, but Disney does a whole lot of other stuff besides cruising. So I'm actually looking at an apple and a pear. I'm not really looking at the same thing. And that's one of the biggest problems with multiples. Matter of fact, earlier this semester, we talked about a company called Raytheon. And when we look at their competitor list, Lockheed Martin is on their competitor list, as is Northrop Grumman and General Dynamics. Okay? But here's the problem. We already know this. Raytheon, half their business is commercial airlines. So I'm comparing a business that's half commercial and half defense with companies that are almost all defense. Right? So I already know that that's not an exact comparison. But those are the compromises we have to make in multiple analysis when we find peer groups. Because it is rarer in today's world to find pure play companies that only do one thing. And so the problem when you do a multiple analysis is that when you do a multiple, you're doing the whole company, which means you do lots of things. So for example, CVS is a good example. Like if you do CVS, who do you look at as their competitors? Because, and I'll go to CVS here. It's a quick example. But if I look at even the default comparables in Bloomberg, and I look at, where is this? Markets. Trying to see where the multiple spreadsheet in Bloomberg is. Oh, here we go. If I look at PEs in the future, let's do this. Here's a multiple custom template I did that has these multiples on it. So it's got EV to, it'll load, PE, EV to EBIT, EV to EBITDA. Just three multiples on here. Okay. The point is, and this is the industry average, if I'm looking at this group of CVS peers, there's the PE, there's the EV to EBIT. But if I switch this to food and drugstore peers, which is basically Walgreens, notice that the PE is not 17.5 anymore. The PE switches to 10 and 11 for EV to EBIT. So that's the point. Like, if I do CVS, who am I comparing them to? Because part of their business is looking like a drugstore chain. Part of their business looks like Aetna, which looks like an insurance company. So if I switch this to healthcare peers, then the multiples here are going to be, again, higher and different for the healthcare peers versus the Rite Aid, Walgreens type peers. So that's the point. Like, you're going to get different peer sets, same company. So which one do I actually use, right? So that's the problem with multiples, is that finding pure play competitors is not easy in today's world anymore. So we compromise, and we do kind of like this, where they'll put companies together that don't always do the same thing. And that's just a limitation of the multiple analysis. But this is actually, believe it or not, one of the most important parts of the multiples is finding peers that are similar. And since it's hard to find diversified companies that are similar, what we do is we say at least similar in growth and return. Because what we're about to find out is multiples are a combination of growth and spread. That's all they are, future growth and future spread. So what I want are similar companies that have similar growth rates. So I don't want to take a startup growing really fast and a mature company in the same industry, because they're going to trade at different multiples. If I can find more mature companies, then those are going to be more comparable to faster growing companies. Same thing. Bundle them together by growth and ROIC or spread, as opposed to just what they do. That's kind of a best practice for multiples. Ideally, if you can find pure plays, all the better, but you're not always going to find that. All right. So that's the challenge with multiples. The advantage is multiples are easy. The challenge is that it's hard to find peer groups. The other challenge is we're using essentially 3 or 4 numbers to represent the entire future of the company. And so we've oversimplified the company to those 3 numbers. It's a broadsword. It's not a scalpel. Okay? We just got to remember that when we're doing multiple analysis. So the steps are pretty straightforward. Find a peer group, take some time to do that. For simplicity this semester, we'll use Bloomberg standard peer groups, but that's not always ideal. Okay? Then get the data, which we're going to talk about how to do it. Estimate the data behind the multiples, benchmark, compare, and explain. Best practices, choose similar companies based on ROIC and growth prospects. We're going to use forward-looking multiples rather than historical multiples because they are more representative of the value of the firm. I'm worth the sum of my future cash flows, not my historical cash flows. Third, enterprise value multiples are preferable to price to earnings multiples. PE is generally used, pretty common, which is price per share divided by earnings per share. But the challenge with PE is it's based on net income. And net income can be affected by a lot of things, including interest expense and non-operating items. So the problem with PE and net income is that there's actually more things that affect a PE because you got to explain all the operating drivers plus the financial drivers plus the non-operating drivers and difference potentially in tax rate to explain a difference in a PE. Therefore, the professionals tend to prefer enterprise value to EBIT or EBITDA multiples because when you get down to EBIT, below EBIT is all that other stuff, non-operating items and interest. And that doesn't affect as much the EV to EBIT and EV to EBITDA. So they give cleaner views of operating performance. So those tend to be more preferred than the enterprise value multiples rather than the PE multiples. I'm not saying we don't do PE, but I'm just telling you that the enterprise value could be preferred. So in this class, we also have to be careful about adjusting because two companies that have the same operating performance, but one has a huge amount of cash on its balance sheet and the other doesn't. Well, that non-operating value is going to distort the multiple. So that's another challenge in multiples. Non-operating values can distort multiples. We got to be careful about companies that have a lot of non-operating value. Okay? So we might have to make some adjustments for that. This semester, because of where we are, I'm going to hold you to doing 3 multiples, not 4. Okay, normally we would do 4, but given that we're the week before Thanksgiving, I'm just going to have you do 3. The 3 multiples are PE, EV to EBIT, and EV to sales or revenue. Those are the 3 multiples you're going to be responsible for, calculating and explaining on the companies that you're going to analyze. So let's talk some math. Starting out with the key value driver formula. This, as a reminder, is the key value driver formula, right here. We've been talking about it all semester. It's what we use for our continuing value and our valuation model and what's key to valuation. Okay? Multiples are just that key value driver formula rearranged. That's all they are. Okay? So, with that formula in mind, let's go back and talk about a multiple. So here's what we're going to do on this table. Plugging into that equation the following data. We're going to have 100 million of NOPLAT and a 10% WACC. And then we're just going to plug in different ROICs and different growth rates. And based on all that, we get the results in the table. Okay? Just putting that data into that formula, we get these results. Okay? So based on these results, if we have a 10% ROIC, 100 million in NOPLAT, 10% WACC, regardless of the growth rate from 1 to 5%, $100 million would be worth $1 billion. Why are these values not changing as the growth rate is increasing? So the growth rate goes from 1% to 5%. Why are these values over here not changing? Why is it saying $1 billion in that formula? Yeah.
Is it because the return on income is equal to your WACC?
Yeah, the zero spread. And we know from early in the semester that growth at a zero spread doesn't change any of your value. So that's the point. At a zero spread, companies are all worth $1 billion, regardless of the growth. So if the company has a negative spread, ROIC of 6 or 8% against a 10% WACC, the faster you grow, the worse off you are. And the company has a positive spread at a 14, 16% ROIC against 10% WACC. The faster you grow, the more valuable you become. Those are just key insights for the key value driver formula we already know, okay? But are important to multiple analysis. So everybody understand that and how these numbers, where they came from? All right, so let's go to the next slide then. So carrying this slide over, let's do an enterprise value to EBIT multiple. So at 100 million of no plat and an assumed 35% tax rate, just throwing a number out there, that would be a pre-tax EBIT of 154. So just 100 divided by 0.65, 1 minus the tax rate. Okay? So 154 of EBIT at a 35% tax rate gets me 100 million in no plat. Just work backwards to get that number. Right? So what is an enterprise value to EBIT multiple? Well, if I have $1 billion of value and I have 154 million of pre-tax profit, that is a multiple of 6.5 times earnings. So in this spread, in this industry, a zero spread is a 6.5 multiple. So my question to you is, if I saw a company in this industry trading at 6 times EBIT, what could I infer about that company? If you have a company trading at 6 times EBIT, what could you infer? Where are the sixes on the table? Yeah. Go ahead.
It's cheaper than.
They're trading at a discount. They're cheaper. But why? Why are they trading at a discount? Why are they trading at 6? What do we know that would cause them to be trading at 6? Yeah. They likely have a negative spread. Now, do you know what their ROIC is? Exactly? Because it could be a range. Because if I think about where my 6 is, here's a 6. And somewhere in here is a 6. So if I think about it as a range, somewhere in this range of results is probably where the company is trading at. So I can't tell you exactly what the growth in the ROIC is, but I know it's relatively low growth and likely a negative spread. What if a company was trading at 7 times earnings? What would a 7 times EV to EBIT suggest? Well, think about where are my 7s? 7, 7, somewhere in here is a 7. Yeah.
That's a positive spread with like a higher ROIC.
Yeah, positive spread with a higher ROIC at, again, low growth. So that's the point. Company trading at 6 times earnings likely has a negative spread. Company trading at 7 times earnings probably has a positive spread. Company trading around 6.5 times earnings probably has close to a break-even spread. We can work backwards knowing the key value driver formula to make assumptions about multiples. Does everybody understand how we're coming to those conclusions? Because this is what you're going to be doing and writing up for real companies next week. Multiple number 2, price to earnings multiple. We're going to take the exact same key value driver formula, except because we're going to do it based on price to earnings, earnings is earnings per share. Earnings per share is net income. That is an equity cash flow. Okay? So what we're going to do is we're going to plug in the equity cash flows into the key value driver equation. Therefore, no plat is replaced by net income. Return on invested capital is replaced by return on equity because it's the return on the equity cash flows. The cost of capital becomes the cost of equity because I'm discounting the equity cash flow, not the equity and the debt combined. So therefore, cost of equity instead of WACC. Growth is the growth in the net income, not the growth in the free cash flow or the no plat. Okay? But same formula, just equity cash flows, PE. So that version of the key value driver formula, same concept. $100 million of net income, 10% cost of equity at these different return on equities and these different growth rates, you have the different equity values of the firm, therefore the price. So, for example, at a 10% ROE in the key value driver formula, $100 million of income at a 10% cost of equity at zero spread is worth $1 billion. That's the equity value of the firm, okay? Regardless of the growth. And at 8% ROE, it would be worth a negative spread, $972 million. So here's the point. If I take the value divided by the income, price divided by earnings, 972 divided by 100, they would trade at a multiple of 9.7 times earnings. Company with zero spread would trade at 10 times earnings. So same concept applies. If I have a company that's trading at a PE multiple below 10 in this industry, they likely have a negative spread. If I have a company trading at a higher than 10 multiple in this industry, they likely have a positive spread, ROE versus cost of equity. Questions? Multiple number 3, enterprise value to EBIT multiple, and the enterprise value to sales multiple that comes with it. So same concept. Start with the key value driver formula. That's the top. Rearrange the math to get to enterprise value to EBIT. So we know that NOPLAT is EBIT times 1 minus the tax rate. That's how you get to your NOPLAT. So here's the point. I'm going to divide both sides by EBIT, enterprise value to EBIT, and I'm left with 1 minus the tax rate times 1 minus G over ROIC over WACC minus G. This is the formula for enterprise value to EBIT. If I were to plug those numbers in, those 4 numbers in, I could estimate what the enterprise value to EBIT would be. Again, all based on key value drivers, all based on growth and spread. The only difference is in the enterprise value to EBIT formula, what I can do is I can break out tax rate as an explicit driver. Right? In the traditional formula, I didn't have tax rate as an explicit driver. I just assume whatever the tax rate is today, it doesn't change. Right? By rearranging the math, I can break out tax rate as a driver. But that's enterprise value to EBIT. Final multiple, EV to revenue, also known as EV to sales. I start with key value drivers. NOPLAT here is revenue in dollars times the EBIT margin. EBIT times 1 minus the tax rate over revenue. That is NOPLAT in dollars. Divide both sides by revenue. The revenue dollars on the right cancel out. So EV to revenue is your EBIT margin. This is the EBIT margin right here. That's the margin. Times the rest of this. Or sorry, EBIT margins right here, pre-tax. EBIT divided by revenue times 1 minus tax rate, 1 minus growth over ROIC. That, the EBIT divided by revenue is right here, times the rest of that formula. The rest of that formula is this. It's the EV to EBIT multiple. So that's the point. So here, enterprise value to revenue is your EBIT margin, EBIT divided by revenue, times the enterprise value to EBIT formula. That's what we've been using for the last few weeks in our valuations. So in your valuations, we've been estimating the EBIT margin, EBIT divided by revenue, by taking the enterprise value to revenue sales and divide by enterprise value to EBIT multiple. Okay? That's what we did even this morning for Royal Caribbean. So that's where we came from. Because I know that all of these multiples are just the key value driver rearranged. And so when we rearrange it, we get the different multiples, and we get the different insights as to what's driving those multiples. Questions? All right, so let's go to what we're going to do for the analysis and our real world. So I gave you a template, which is called your multiples assignment. Template. Back one. So this is the blank template. I've made your life a little bit easier. Rather than just saying, take those formulas and create your own template, I put those formulas in this template for you. Okay? So the first has 2 tabs, 2 worksheets. The first worksheet is for the PE multiple. Okay? So right here, this value cell is basically the key value driver formula already put in there. Okay? And so that value divided by that net income would be that PE. Okay? So the three companies we're going to do as an in-class example today are Costco, Walmart, and Target. So we need to do the analysis for the PE first on these three companies. In order to do so, you're going to need 2 screenshots from Bloomberg. And you'll have to submit the screenshots along with the Excel file, along with your write-up explaining the reasons why the multiples are different. That's going to be homework 11. Okay? So, with that in mind, Costco, what are the screenshots we need? We'll start out with we need their cost of equity. So we're going to go to Costco in Bloomberg. And we're going to go to the WAC screen. And this is screenshot number 1. So up here, take screenshot, save screenshot, Costco, WAC. Did this in an earlier class, so I'll just replace it. All right, this is their WAC, but up here is their cost of equity, because the WAC is the weighted average of the cost of equity and the cost of the debt. So once we're doing a PE, we care about cost of equity. Right now for Costco, 8.9%. So right here, cost of equity, 8.9%. Second screenshot we're going to need is EEO. So for Costco, these are the forward estimates. Now, I told you that we're going to use second forward year. Okay? That's what we're going to use, because the forward multiples are more representative of a valuation than the historical multiples. And the second forward years we get more normalized because that's the first full year that's forecast. Okay? So for our purposes, we're going to use the second forward year. We can count over the columns. This is history, last year, forward year 1, forward year 2. It'll always be this column. So at forward year 2, the net income for Costco is expected to be $7,174,000,000. So 71.74 of net income. Right? Next, we're going to need a future return on equity. Now, this is the return on equity into perpetuity. So I need something representative. Right? So one way I could do this is I can go back to my EEO, and if I continue scrolling down, you'll notice that the analysts are forecasting return on equity. Those are the next year, 4 years of forecast for return on equity for Costco. So last year, the return on equity was about 31%. This year, 28.6, 27, 24, 25. Relatively stable going forward. Okay? So I'm going to just say 25% I think is representative of Costco's return on equity going forward. Plus or minus 1, your numbers aren't going to change too much. Now I could take all 4 years, I could average them out. I'd say that's what I'm going to do. I'm going to be kind of more lazy here. But that's the point. I need a representative of what I think the future is going to be. Everybody see where I got the 25 from? Final number, right now, what's their actual PE for the second forward year? Well, right now, based on that share price, $512.64, divided by that earnings per share, which is that income leads to that earnings per share, price to earnings is 31.87. So the PE in the second forward year right now is they're trading at 31.87 times earnings. So in my little template, 31.87. So here's the point. Using the key value drivers, I'm estimating with no growth a PE of 11.24. Clearly the market expects them to grow if they're buying them at a price of 31.87 times second forward year earnings. So what growth gets these to be exact, gets these to be the same? Okay? So I'm going to solve for the growth rate. The easiest way to do this is to use Tools Goal Seek in Excel. So what I'm going to do is I'm going to set cell B9, the PE that I'm estimating, to be the same as the market PE, 31.87, by solving for the growth rate, which is B3, and that's going to tell me that the market is using a growth rate somewhere around 6.59%. That's Costco's G. We're going to do the same thing for Walmart. Walmart. Oh, so I'm on the EEO screen. I'll take a screenshot of the EEO screen, which I did in an earlier class, so I'm not going to do it right now, but this would be the screenshot. Right now, Walmart, second forward year, 1-2, net income, 17,691. Walmart, expected return on equity for the next 4 years, they went from 17 to 18 to 21 to 21 to 20. So I think 20 to 21 is probably a reasonable long-term return on equity for Walmart. I'll use 21. Cost of equity and PE. PE right now, current price divided by second year earnings per share, trading at 21.42 times second year earnings. 21.42. Okay. And finally, off the WAC screen, Walmart's cost of equity is 7.7%. So if I goal seek their growth, Tools, Goal Seek, set cell C9 to be 21.42 by changing cell C3. And that's going to estimate a G of about 3.9%. That makes those multiples equal each other. Model versus real world observed. Okay. Finally, for target, similar process. The target WAC, or sorry, return or cost of equity is 9.4% right now. So 9.4 off of their EEO, which I've taken a screenshot of both of these. The net income, second forward year, 53.41. The expected return on equity, 32, 51, 61, 53, a little bit more bouncy. I'm going to use 50%, but I'll also tell you that once you get above about a 30, 35% WAC, the difference between or ROIC, the difference between a 35% and a 50% ROIC has very little change in your key value drivers model. Very high returns on investment don't have huge impacts in the model. At that point, it's all about the growth. Okay, so being in the 50s, whether you said 55, 45, 50, it's not going to change this analysis that much. I'm going to use 50. Okay. And then finally, their observed PE, 14.51. Second forward year. So again, using Goal Seek to solve for their expected G. Tools. So again, I'm going to set cell D9 to be 14.51 by changing D3. And that's going to be about 2.91% G. All right, so once I've got my data, I save my data, I'll lose all this, I now have to do my write-up and explain the differences in these multiples. And the language which we'll use are premium or discount. If your multiple is higher than somebody else's, you're said to be trading at a premium. If your multiple is lower than somebody else's, you're trading to be said to be traded at a discount. Therefore, Costco's trading at a premium to Walmart. Walmart's trading a discount to Costco. And then we need to say why. These cells explain the why. Multiples are growth and spread. So here's what we know. Walmart's growth is 3.9% per year into perpetuity. Costco's growth is almost 6.6% per year in perpetuity. So I know in key value drivers, if you grow 2.5% more than your competitor into perpetuity every single year, that's going to lead to a higher valuation if you have a higher spread. So one of the reasons why Costco's trading at a premium is that extra 2.5% rounding off, 2.6% rounding off, higher G. Okay. Second reason, Costco has a higher spread. 25 minus 9 is about 16 points of spread. 21 minus 8 is about 13 points of spread. So Costco is growing at a much faster rate that higher spread. That's why they're trading at a premium. That's why they're trading at 32 times earnings, and Walmart's only trading at 21 times earnings. Everybody see that? It's pretty straightforward. However, there's another factor at work here. If you have two companies that have identical WACs, then the growth of spread explains everything. However, if the WACs are different, then the WACs also play a role. Because I have two companies with identical spreads, but one company has the lower WAC, even with the same spread in the lower WAC, I'll be worth more. Okay? So, translation. If Costco had the same cost of equity as Walmart, 7.7%, their PE would be 66. Their PE wouldn't be 32. So that's the point. That higher risk at Costco, that cost of equity of 8.9% versus 7.7% at Walmart, is offsetting how much value they're creating by the higher growth and spread. So when you're answering this question, it's the extra 2.6% G at Costco at the higher spread of 16 points, offset by the higher cost of equity that's 1.2% higher, which is actually causing them to trade at 32 times earnings. And so that is why they're trading at a premium. Let's look and see what's happening at Target. At Target, their growth rate is the slowest in the industry going forward, 2.9%. Okay? Now, Target has an extremely high spread, almost 40 points, 50% ROE against a 9.4% cost of equity. So that 40.6% spread is not as valuable because they're only growing at 3% a year, 2.9% a year, as Walmart or Costco. So that's why Target is trading as a discount to both at 14.5 times earnings. In addition, Target has the highest cost of equity in the industry, 9.4%. That further lowers their PE, because if they had Walmart's PE as an example, 7.7%, what just happened? They would PE approaches Walmart's. It'd be almost 20. Okay? So the other factor, besides lower growth at high spread, that's affecting Target, is their much higher risk by having a cost of equity at 9.4%. That's the other reason why they're trading at a bigger discount to Costco as well. Make sense? This is what you got to write up. Using these numbers. Questions? All right, let's talk about multiples 2 and 3. EV to sales or revenue and EV to EBIT. That's tab 2. We know the formula for EV to EBIT. It was derived in the lecture notes and in the book for the key value drivers. So I have put that formula here. This is the EV to EBIT multiple formula right there. Okay? So I need these 4 values. I need a G, I need a tax rate, I need an ROIC, and I need a WACC. Okay? So let's start out with the WACCs. I've already taken my screenshots. So I go back to my Costco screenshot. I go to the WACC screenshot. But on this tab, instead of using the cost of equity, I actually use the WACC. So it's 8.7%. And since I'm on the WAC screen, for Walmart, their WAC, 7.1 on this screen. And for Target, their WAC, is 8.3. So I put in the 3 WACs. All right. Next, I go to my EEO screenshots. What do I need to get off my EEO screenshot here? I'm on Target. I need my EV to revenue multiple and my EV to EBIT multiple in the second forward year. So EV to revenue, 0.86. So people are paying 86 cents of value for every dollar of sales at Target. And my EV to EBIT, they're paying 13.18 times second forward year's EBIT. Now I'll go to Walmart, or 13.18, sorry, 16, 13.18. Next, I'll go to Walmart, off of their EEO. Second forward year, they're paying 71 cents per dollar for EV to sales. And for EV to EBIT, they're paying 17.09 times second year EBIT. And finally, for Costco, off by screenshot, they're paying 86 cents per dollar for sales. .86. And EV to EBIT, they're paying 23.32. All right. Now I need an ROIC and a tax rate. Okay. Here's the deal for ROIC. Bloomberg doesn't give you an ROIC in the EEO screen. But what we know is that the return on equities for all these companies were pretty stable. And more importantly, they were very similar to the current ones. So usually the past doesn't equal the future. But for these companies, the past is actually fairly representative of their future. So here's what we're going to do. I'm going to go to the RV screen for Costco. I'm going to go to my operating ROIC template. And I'm going to use these operating ROICs because I think they're representative of the future. Now, option B, I could do a DCF as is valuation for all 3 of these companies and get a much closer number. That'd probably be the better number, all right? But I'm going to be lazy. Let you be lazy here. But here's the problem. If we were doing Royal Caribbean, I couldn't do this. Right? I can't use last year's ROIC as representative for their perpetuities. It would not work, okay? But for these 3 retailers, it probably will work. So I'm going to use Costco's operating ROIC is 26.5%. So 26.5%. Walmart's operating ROIC last year was around 14%, rounding off. And Costco last year, Target last year was around 25. Finally, I need my tax rate for Costco. Type in my guidance. 26%. For Walmart, my guidance was around 25.5, not too different. Target didn't have a guidance, so I had to go to BRC, look up JP Morgan. In the last class, when I did that, the JP Morgan number was around 22 is what they were using for their tax rate. Okay, so I fill that in. Okay, and in the interest of time, I then solve for the G's, and I basically use my goal seeks. So tools, goal seek, set cell, in this case B11. I want to match the EV to EBIT, 2332, by solving for the G, which is B5. That's 6.28%. Okay, and then I do the next two cells. Okay, so next cell, goal seek. Set cell C11 to 17.09 by solving for C5. So it's 3.98% G. And if I use my goal seek here, set D11 to 13.18 by changing cell D5. About 3% G. So now I'm ready to explain. These values explain these EBITs. So why is Costco trading at a premium EV to EBIT over Walmart? Very similar. They have very similar tax rates. So I know the tax rate's not really a difference. Their spread is much higher at Costco. 26% ROIC minus 8.7% WACC is much higher than a 14% ROIC against a 7% WACC. So Costco has much higher spread at much higher growth, 6.28% versus 3.98%. So it's the high growth, high spread that's leading to the premium. However, they also have the higher WACC, which is a headwind, which is mitigating some of their advantage. Okay? Why is Target trading at a discount to Costco? Because they have the lowest growth in the industry at 3%. So even though they have the similar spread of Costco, that much lower growth rate gives them an EV to EBIT of 13 times earnings versus 23 times earnings. Okay? And Target does benefit by having a little bit lower WACC than Costco. So that actually is helping that 13.818. It'd be lower if they had the same level of risk. So lower growth is hurting them. Lower spread, a similar spread, slightly lower, is hurting them. But they're being slightly benefited, targeted by a slightly higher WACC. Sorry, lower WACC. It's giving it a little bit higher value. Everybody see that? All right, final one, EV to sales. Generally, EV to sales, as you read in the book, is margin. I pay more for somebody's sales if they have a higher level of profitability. Here's the problem. Costco has the lowest profitability relative to Walmart and Target, yet they have the best EV to sales at 0.86. How could that be? Well, for Costco to get the 3.7% margin, Costco invests less than half of what Walmart does in invested capital to make that margin. So that's the point. Generally, if the productivity is the same, I would pay more for the higher margin. Walmart, which has to spend twice as much to make the same margin, that's why people are paying less for their sales, because they have worse productivity. Translation, lower ROIC. Target, highest margin in the industry, but their EV to sales is about the same as Costco, because again, they're spending double what Costco is to generate that profit. Okay? So, two drivers for EV to sales: margin, productivity. Okay? 4 drivers for EV to EBIT. 3 drivers for PD. You have to calculate these, 6 screenshots. I'll give you 3 companies later today. You need to basically turn this in next Monday as a 500-word paper explaining premiums or discount using numbers for these companies. That's the homework assignment that's due next Monday. Dentsu is due next Monday for presentations. Turn them both in by 8 a.m. Last but not least, because you need to grab a lot of data this week, I'm going to give you Wednesday in class as a Bloomberg lab day. So there's no lecture on Wednesday. It's just the ability to come back in here and get the data. Thursday, Friday, TAs have office hours. Do not email me on Sunday night at 10 p.m. saying I'm having trouble with the Bloomberg lab data. It will be too late. Do this on Wednesday. That way, if you have problems, you can either get the problems resolved or work with the TAs later this week to help you with this exercise. Okay, they have office hours. You go to any TA's office hours on Thursday or Friday. Take advantage of that this week. Lab will be open to do the data collection on Wednesday. See everybody 1 week from today. Have a good week. Where's the sign-in sheet? Make sure you sign the sign-in sheet if you haven't. This has been recorded and will be posted on YouTube.